Hello, this video is going to be about Canada Goose, and I've been invested in Canada Goose in 2 years now, for 2 years now. My buying price is around, I think, $25, $27, which is seems really high right now, where the company is at right now, and the share price, of course. But at the time, it seemed to me like a good growing company with good return on invested capital, with good margins, good management, which we will talk about today. Is it that good? I didn't think it was super cheap, but I didn't think it was expensive also at the time. I thought that when the company grows and gets to $150 to $100, it won't matter that much if I bought it at $25, at $36, or at $10 like it is today. I still think that there is some truth to that, but of course the $1,000,000 question is, will it get to $150 to $100 in a timely fashion, like in 30 years? And yeah, fortunately for me, it's not a $1,000,000 question, or unfortunately maybe. So yeah, we will try to answer that today. And it is kind of funny, I'm making this video today because they are reporting tomorrow. So it made sense for me to wait until tomorrow to become smarter and then to record this, my conclusions. But I've been analyzing it for a few days now, and I have all this in my short-term memory, and this is the main reason I'm doing those videos. So I do want to capture my thoughts at this moment, and if I want, I can always make an addition after the reporting tomorrow. I probably won't, but yeah. So just really a brief overview. Canada Goose, a Canadian company that traditionally made really heavy-duty functional coats for Arctic expeditions, and the grandson of the founder, which we will get to talk about the management, when he took over, he really took it to the next level and turned it into a fashion, like a luxury premium fashion company, and began to expand in the world, in the United States, in Europe, and now they're focusing really in Asia and China. So obviously they've been focusing on the coats, on the jackets, and so this is very seasonal. And tomorrow, and it is at the end of the biggest quarter of the year, so it is funny to make a video before the big report tomorrow, but that's the way it is. And right now they're trying to diversify the products. So they've been. Oh, let me just put myself here. So they've been, of course, focusing more on the coats, heavyweight down and lightweight down have been the majority of their sales, of their business. And now they're trying to diversify more to other products. Will they make it? Will they not make it? We don't know. Will it be successful? The fact that they are doing good coats that people love doesn't mean people are going to buy their sweaters and their now footwear and their knitwear and their hats. People, of course, are somewhat buying it because it is a brand. But I don't know, this plan to make the coats less their biggest business and to focus more on other items, I'm not sure how it's going to play out. Of course, no one is sure, so it is a risk. So right now, this is today, we still see those are the coats, and this is the other business. And they're aiming, they want to make it, of course, less seasonal also, because they have this big season in the fall and the winter, and then in summer they're usually at a loss in this quarter, so they want to smooth it out. It's okay if they make it, of course, great. They do have an experience with building their brand. I mean, they are doing something right. So good luck. I hope they make it. So it is a strong brand. This is just a few screenshots. So mainly, not many, only from the US. So it just goes to show that it has some cult following. It is a strong brand. People love it. Of course, those are super expensive jackets, much more expensive than Columbia and North Face and other brands. But people love them, and they love to wear their Canada Goose jacket and to stroll New York streets with them. Again, it seems that they're doing something right. They have a big base of repeat customers, and I have read a lot of reviews about Canada Goose jackets, and I have noticed it online also that people always brag that they have a few coats, and I've been buying my 5th coat now. I mean, not that they usually have it at the same time. I think they change it, but once people get started with Canada Goose, it seems they love to continue with that, and they know all the different models, and they travel long distance to get this specific model they want. So it's really, I think it shows really some brand recognition, and somewhat mode. Of course, it's fashion, and it can always go up and go down. And we can see in the Google Trends that there are some signs that they might have peaked in terms of the brand awareness and the brand success in 2021. And since then, it's just haven't been the same. We can say I've looked at Google Trends in different regions, different periods, and it all shows the same. It's not the end of the world. It doesn't seem that bad, and of course, it's not very accurate also. But it's not just the Google Trends. There are some signs of it all over, including in the financial results, of course. But of course, it could be the end of Canada Goose as a big brand, or it could be cyclical, or it could be, that they need to step up their strategy and their marketing game. So it could go either way, and we'll talk about it. But of course, those are one of the biggest risks that you're placing, the bet you're placing when you're investing in a company, in a fashion company like Canada Goose. Just this highlight here. We'll talk about the management soon, but they've been always all the time saying that they're still very confident in their brand, and they're sure that the brand is still very strong. And even if there are some macro headwinds right now, they're very confident in the brand, and the traffic is getting better and better. But when you look, this is from the annual report already a year ago. But this is what we have right now. So they are mentioning in their annual report that the retail store traffic has not, it's not until this year, it's until a year ago, has not did not rebound still from pre-pandemic levels. So yeah, there might be some slowdown in the brand, the strength of the brand right now. Again, it could go either way from here. I'm not so quick to bury Canada Goose and say that's it, that's the end of it. So in terms of customer service, there are also some problems. First of all, if you look at Google Maps, all the stores all over in all the world have really low reviews. And they have this unique in-store experience. When you get there, you need to wait in line until they greet you, and then they accompany you, and they try to fit a model for you and find your size. And it's not very usual. Maybe it is in the premium brand, but it's a unique experience, and maybe this relates to some of the unmet expectations of customers. I haven't seen a big warning sign in this term, like something really common, but the reviews are very low. But again, it seems to me that people love the coats, they love the product. Sometimes they get a bad experience at the store. It's sometimes that the model they're looking for is not there, so it's not as well stocked as they expected, and a lot of it has to do with the warranty. Canada Goose does give a lifetime warranty on some parts of the coat, which is great. So a lot of the bad experiences people have is when they get their code to the store and try to activate their warranty, and they have some disappointments there. It seems that the customer service in terms of the warranty is not the best. Of course, people will always complain, and there is the bias that you see only the bad reviews, because people who are content with the service will not complain. But still, it's not like that for other brands. So there is something a little bit disappointing here. In terms of the production, they are proudly naming themselves a very Canadian brand, and they are committed to the majority of production to be in Canada. So there are some parts of the production that are overseas, but they're really small, and they're really trying to make it very Canadian and to market it like this, and I think it's all good. The only thing I have to mention here is that the workers in the factories of Canada Goose have united to a workers' union, which couldn't be good news for us investors. But it has been some time, and until now there weren't any bad news coming from it. But it could always happen, not the best. And that. Of course, the minimum wage in Canada, it's of course higher than in some other countries where their competitors produce, but more than that, there are inflations right now, so there is an inflationary pressure on salaries, and the minimum wage is expected to go up. So yeah, it's probably like that everywhere, but just to mention it. So okay, we're getting to this real stuff now. So the management, I will talk now about the management, a little bit the growth of the company, which there isn't much to say, and then the margins, which there is a lot to say, somewhat about the capital allocation, and we get to valuation. So the management of the company, first of all, who they are. Danny Reese is like I mentioned before, is the grandson of the founder of Canada Goose, and he was the one that really took it to the next level with the marketing, and he just converted it into a really fashion brand. He transferred the model they were selling to wholesaler, and he completely changed the model to direct to consumer, and they began to open stores, Canada Goose stores, which there weren't once before. And he took the company public, so he's really the one that really took the company to where it is today. So I don't know. I always thought that was a good thing. Nothing is perfect, and I think there are always some discrepancies between the interests of the management, any management, and the shareholders. I mean, they're not in the same boat. So out of the spectrum of the types of managements we do have, I think the grandson of the founder, he really loves this company. I'm sure of it, and he wants the best of it, and he's looking long term. I'm sure of it. Is he perfect? Not. No. And lately I'm seeing more of some warning signs. Of course, he can make mistakes. So, like everyone, but this kind of a manager also is prone to a unique kind of mistakes. And I think, and there are some signs, some red flags about it. I mean, it could be some exuberance right now in terms of how much success he had with the company, and how much he managed to grow it, and the expectation that the things will continue like that, and that he needs to grow it. I mean, I think there is something, I don't want to say greedy, it's not necessarily material, but it could be like... Overall, I think there are some sides of exuberance. I mean, I think they were managing the company very solidly until a few years ago, and now I don't think like that anymore. I mean, they're still profitable. Their return on invested capital has decreased, but it's from different reasons. But it's still okay. but yes, to me it feels that they're aiming to grow too much and in too many aspects, and geography and the different products and footwear, and it's just a bit too much. I hope they can keep their modesty and to aim at the realistic goals, which they don't, and we'll talk about it in a minute. So this is a little bit worrying. So at one point, Danny Reese wanted to raise capital to grow the company, to finance the growth of the company, and I think it was before they went public, and he took an investment from a private equity firm called Bain Capital. So today, Bain Capital and Danny Reese together hold like a majority stake in the company, and they have the majority of the voting shares. So just to mention, there's nothing really special here, but there is. I mean, overall, I don't see anything wrong with it. I think it might be even good that there is a private equity firm that is involved with the company and is really invested in it, and it's really interested in the company to grow, and of course its valuation to grow. So yeah, I think nothing wrong there, just to mention it. So like I mentioned, my biggest problem with the management at the moment is it seems that they're really setting unrealistic expectations. I can't say for sure if it's for themselves also, or it's mostly for the public, for the investing community, for Wall Street, of course. But yeah, they're definitely. So if we look, they had an investor day this year, and they have announced their goals for the next 5 years. And I think it's absolutely crazy. I mean, first of all, macroeconomics are not that bad right now, but there are some signs of a slowdown. Interest rates are up, and there definitely has been signs of a slowdown in the expenditure of consumers, especially in super sensitive areas like luxury, fashion, and there's all things discretionary, in short. So given that, even without this fact, their goals are, which we'll talk about in a minute, are really high, and it's very ambitious. I mean, too ambitious. But taking into account the state of the economy right now, I think it's absolutely crazy. I mean, it's out of whack. I don't understand it. Again, I'm not sure if they're just putting a show for Wall Street or they really think that. But it is I mean, I wish that they could do that. But and I'm not saying it's absolutely impossible. But it's just so unrealistic to aim for that, especially when you don't know where the market is going, and you see all the companies that are in the fields related to you, around you, are slowing down. How are you expecting to grow 20% a year? Yeah, they haven't been doing that in the last years where there was a crazy bull market. How are they going to do that in the next 5 years? I think it's unrealistic. I mean, again, I wish. I'm invested in it, and I probably won't sell at the moment, so I wish they could do it, but it's just this is a major red flag. I mean, why not set more realistic goals? And if you outpace it, if you outdo it, great. And if not, still you have something normal, something modest to aim for. I mean, you should be ambitious, and you should grow, and you should strive for the best for the company, but this is too much. So yeah, so they're expecting to grow 20% a year from now on. Their margins have been down for the last years. They used to be much better, so they're pretty much aiming right now to get them back where they were a few years ago, maybe a little bit better. But it's a different company today. It grew so much, and it changed so much, and both the business model and the product mix, and we'll talk about margins in depth soon. But it's the fact that they were there a few years ago doesn't make it easy to get there again. I mean, it's a different company, and there are different factors working in right now. So I think the expectation of the margins is crazy. The expectation of the growth of the revenue is crazy. They're expecting to grow the revenue 2x in North America, where Canada is their biggest market traditionally. They are really expanding in the US, which is not a big market yet, and compared to, of course, the potential in the total addressable market, and they're just expanding to the West Coast now. So there is a big potential there, but I don't know. Again, Canada is pretty much a mature market for them. They can always open more stores, but so growing that 2x, yes, it's ambitious. EMEA, I don't know, might be, but in APAC they want to grow 4x, and right now it's not going great for them. I mean, they were their biggest market after Canada and the US. They're looking at right now is China, and it's not going well at all. And they're very optimistic. There are some headwinds, and it's just gonna solve itself in a few quarters. And there were the COVID lockdowns, and there were different factors working in China. But they're pretty confident that their brand recognition is great there, and it's gonna get great in just a few quarters. And it really seems, I mean, they're planning to open a lot more stores there. This is China. They have entered the joint venture in Japan. So they're having like a new business model in Japan now. So they're expecting a big, somewhat growth from there, and in Korea. I'm sure they're going to grow somewhat there, but again, 4x, I don't know. Everything here just seems to me too much. I'm not counting on that, and I don't know what to make of it. I'm obviously not going to insert that into my models, but does that deem the company investable? Maybe. I mean, maybe. I'm not sure. I don't know what to make of it. I still think the company could grow well. Why not set just realistic expectations and go with them? So just another example, it's from this presentation from the Investors Day. I mean, this slide makes no sense for me. Like, they're showing the percentage of their market penetration in different countries, and then how if they would get to half of the percentage of the market penetration in Canada in different countries, where would get? It makes no sense. I mean, it's just so illogical. This, I don't know. I mean, 1% in France is not 1% in China. It's different size of market. It's just percentages, and it makes no sense. And why would you assume that you would get to precisely half of the penetration? So this is 16%. Why would you assume that you will get to 8% in Japan, 8% in South Korea, 8% in China? It makes no sense. I mean, something here is off. I mean, in terms of what's going on? I don't understand. I cannot relate to this. It's really a red flag. So this is about the management. Again, I think their interests, I think it's still better than a lot of other managements that we have in the public companies, which are just professional managers that come just to make just to do a few years of a role, to take their stock options and go on, and they don't really care, not about really the company, not about the success of it financially, and for sure not about investors. So again, I want to believe that their interests are more aligned with mine, but what is going on, I don't know. Maybe it's exuberance, maybe it should raise a really big flag, which would doom it ininvestable. I don't know right now. Again, we'll see tomorrow when the report, maybe I will have more insights about it. So just to mention capital allocation, there isn't anything super special here. There is about debt. We'll talk about that in a second. But I mentioned the return on invested capital, which has been a lot higher, and it's down. But most of it, first of all, I do think the company is less efficient. I'm not sure they're going to go back to the return on invested capital they had before. But they are investing in growth right now, so a lot. So it shows on they are investing a lot of capital right now, and the return should come in a few years. So we'll see. There is reason to believe that it will improve. I do believe. Just to show that their cash flow isn't where it's been before, but they're still, of course, cash flow positive and profitable. Again, not where you want it to be. But again, they're investing a lot in growth right now. They're opening a lot of stores now because they're seeing some slowdown that they are seeing. So what, I don't know. But now there's some slowdown. They are putting somewhat. They're slowing their opening of the stores. Also, it's not that they canceled it all, but maybe they canceled what they could when the agreements they already entered. They of course are proceeding with that, but yeah, they're continuing to open new stores and launch new products, and they have all those new campaigns where they aim more towards women, and it all of course. Demands a lot of investment, so we do see that in their capital expenditures. Regarding debt, so first of all, there are the leases which I think are adding to the debt, but yeah, you could say they took debt to finance this growth, but it's not really the case because I'm just gonna skip a few. What we had here is that we see that they took this 200 million in debt, and next year they spent it all on purchase of common stock, on share buybacks. And if we look here, this is from their annual report of 2022 and their annual report of 2023 when they did some share buybacks. So they spent 250 million on share buybacks, and if you calculate it, it brings us to an average price of $36 per share. So it is really promising. So something is off here with the management. I mean, I don't know. At the moment, I don't know. It could look suspicious, and of course they're taking that and they're doing share buybacks at higher price. What are they doing? Is there something under the surface here? But at the same time, I remember when the stock was 36 and I was following it already. And at the time, I still thought it wasn't that expensive. And I saw the company growing and the share price getting to like 70, 100, $150. And so at the time, I didn't think, assuming the company would continue to grow the way it does, I didn't think $36 was a lot. But why do they need to spend so much capital on share buybacks when the company is growing? I mean, you do need to invest in growth. We just talked about how much they need to invest capital. They're opening new stores. They're expanding their manufacturing capabilities. They have all those new products which they're, of course, investing in developing and manufacturing and distributing. So why do they need to spend so much capital on share buybacks? I mean, it makes no sense. Something is shady here in my mind. And then the year after that, they probably continue with the same share buyback program, but we see that at a much lower price, they spent a lot, they bought much less stock, but that's not very material. Anyway, yeah, so something is off. Yeah, so about growth, so this is their growth history. There's nothing much to say. I already mentioned that they're growth drivers. They're moving to DTC, direct to consumer, where the profit margins are much higher, and they have direct communication with the customer, and they can control much better their marketing strategy and their shopping experience, everything. And of course, the margins are higher, which is the most important thing. They expand to different product categories. We already mentioned the geographical expansion. We also mentioned. So yeah, this is all still going on. I mean, DTC couldn't grow forever. They're pretty much ramping it up already. I mean, I think most in their mature non-geography is really mature for them, but from here, DTC is just going to grow at the pace of the growth of the company. I don't think there is much more to move from wholesale. A little bit. They're still lowering their number of wholesale customers, but DTC, I don't think it's going to grow. It's going to go organically from now on. So yeah, the company probably is going to continue to grow unless, of course, there's a problem with the brand, like we said, of the strength of the brand. If it starts to decline, then it's the end of GOOS, and it's the end of your investment also. And of course, the market cycle. If we get a recession, Canada Goose is for sure gonna feel that. So I mean, you could say that there are two sides of it. You could say that who buys Canada Goose? People with a lot of money, and when there is a session, they still have this lot of money to buy expensive stuff. But the truth is, it's not that true. And I think a lot of most of the customers of Canada Goose are not really high income individuals. I mean, it's not low income individuals, but it's somewhere just, I think it's mostly middle class, and they for sure will not buy $1,500 jackets in their session. So the Canada Goose is for sure gonna fill a session if there ever one. Of course, it's gonna come, and sometimes, so we should take that into account. So the margins, I think, are one of the biggest stories with the investment in Canada Goose. I'm gonna move myself right here. So they have, I already mentioned, they had a really big decline in the margins in the past few years due to a majority of factors. But I think the main story here is the growth they're investing in. Not only. Of course, there's some right now inflationary pressure on their costs, and they're trying to, of course, raise prices to pass that on to the customer, but they can't do that really in the same pace. So the story is they're aiming for really high margins, and I think the big story here is that in their mind, or explicit, again, I don't know if that's what they're saying to Wall Street and to us, or they're really thinking that, but as they introduce more other products into their product mix, and of course margins on this knitwear, on a sweater, is not the same as the margins on a $1,500 down jacket. So it's pretty obvious to everyone that the gross margins should go down on product mix, but they're really sending mixed messages, and even not messages, they're plainly saying different things about it. And it seems like the CFO, which is now changing his position, but Jonathan is always insisting on that they will manage to keep the same gross margins even as they diverse into other products with obviously lower margins. And and analysts are always trying to say, how are you going to do that? That doesn't make any sense. And they're just answering something generic like, yeah, we have this algorithm and we're going to keep with it, and we have proved until now that we managed to do it. But how are they doing that? It's not clear. I have one theory, which I read a lot of reviews, and what I suspect is they might be lowering a little bit the quality, maybe not a little bit, the quality of the jackets. So they are like lowering their production costs of the jacket, and it could hurt the quality of the jackets, which people really come to expect from Canada Goose. I've seen a few reviews about it, that people, again, they have a lot of repeat customers, and people who bought a jacket again are disappointed with the quality, and they said it's not the same quality as it was before. So, and it really makes sense when you think about it, when they shift to other products with lower profit margins, but they may remain managed to, until now, really keep the same margins. So they probably improved their margins on jackets. And how did they do that? It's not that the price went so much up in real terms. It's probably they're lowering the quality of the jackets, and this is troublesome. I mean, this is their main business, their core business, and it is supposed to be a premium, a high end. If they're gonna just convert it into cheap stuff, to say it unnicely, it's gonna be a big problem for the brand. I mean, if not that, what will they have? So this is also worrisome. I think that's the main thing with the margins. But overall, there are so many, like you can see here. I'm sure that's not everything. And I mentioned before the unionization of the workers and the minimum wage. But there are more factors, of course, influencing margins, but this is from their presentation, where they're just mentioning probably the biggest one. Pricing, they're planning to raise prices. What will that do? We'll see. And the fact that they're still shifting to DTC, again, I think that's pretty much at the end of it already. But that does raise the margins. Geographic shift to APAC and EMEA. Will the margins in China be higher than in the United States and Canada? I don't understand. Maybe I just don't understand myself. Manufacturing leveraging, of course, that's the big one. I mean, as they grow, there should really get that. I mean, we're counting on that, basically. But again, you kind of expected them to have some of that already, and the margins are only going down. But okay, I get it. They're investing. Okay. And on the other hand, you have the inflation, and here they're mentioning that the product mix is going to lower the margins, but they will never admit that in the conference calls, and that's just, there's something really untrustworthy with them, and that's super disappointing because I expected a management like that. I mean, even not only Danny Rice, even the other ones, they're so many years. I mean, they should really care more. I don't understand it. I mean, they're trying to set those expectations, just, I don't know, to like higher the share price in this short term, but why not look at it more long term? I don't understand. It's really cute. I don't know, so new business models, I don't know what that is, which business models are supposed to lower margins. We talked about the share buybacks, not good, and the debt. They have crazy high short interest, and you could see that more in the Canadian Stock Exchange, because it is a Canadian company. It trades in the Toronto Stock Exchange. It trades also in the United States. But I don't know why the short interest is so high. I was looking at it. I was trying to even look at those companies that are mentioned here, the institutions that are shorting Canada Goose. I was trying to look for a short report. I haven't found anything. This is again, what am I saying? Maybe because all of the things I talked about until now, the unrealistic goals, which are only set for disappointment, but nobody is projecting, really estimating those crazy goals anyway, and the share price doesn't reflect that for sure. So I don't know where the short interest. That's something that I really haven't managed to understand, but it's also troublesome, and even more so because I don't understand why. But I do mention that. So let's talk about valuation. So of course, the valuation of the company depends mostly, again, assuming the brand will still be there in 10 years from now, and it will manage to grow somewhat. I mean, it doesn't decline. So the most important factors in terms of the growth are exactly those, that will the brand manage to grow itself, will the strategy work, and will there be a recession? Again, if there will be a recession, Canada Goose will have a few, for sure, some difficult years until eventually it hopefully bounces back out of those. This is about the growth, and then the net margin. So I've talked about the different factors that are affecting profit margins, but let's talk numbers. So their crazy target is to have an EBITDA margin of 30%, and again, I already said what I think about that. But if we look at 2020, they had an EBITDA margin of 27, which is close to that, pretty much the same. And their net income margin, which is what I look for, I look at the earnings after everything. I mean, depreciation and amortization and the interest rates and taxes. They're all really, maybe not amortization, but depends on the case, of course. But they're all real expenses. So I look at the net margin, net profits and the net margin. So in 2020, the net margin was 15%. So we can say that right now the management, the crazy goals of the management are 15% net income margin. So they will not get there. I'm not going to estimate that and to model that. So let's take the optimistic, the plausible, and the pessimistic scenarios to be, like it says here, the optimistic will say, I think it is optimistic. I mean, 11, 13%, and maybe they could get to 9, 10, which is like, that's plausible. Yeah, that's a basic scenario. And in the bad case, of course, it's not the worst case. It could get worse. I mean, they could become unprofitable. But in the case that the company does manage to grow well, but I mean, okayish, but they won't be able to hire their margins or to get them where they want them to be, or there will be new bad news and new bad things affecting the margins. They could still in a few years be at 6-7% with all different pressures working on it. So this is the pessimistic scenario. So I just want to mention I am looking long term. That's what interests me. But it might also be relevant for long term. That's why I do want to mention it. The expectations, the estimates for EPS for this year are somewhat unclear for me because they really lowered the expectation and lowered the guidance as the year went on, and they did see a slowdown in demand and a slowdown in traffic, which they didn't admit, but we know it. And they had a slowdown in conversion, like they call it, when people are coming to the stores, but they're not buying as much as they used to. So they're lowering the guidance. They lowered the guidance for revenue for this year and for EPS. But the revenue wasn't lowered that much, both by the guidance of the management and the analyst estimates. But the EPS guidance was lowered a lot more. I haven't put the screenshots here. I should have. And I don't understand why. I really tried. I reviewed again the last call when they did that. I was trying to look at different. Maybe I'm missing something. I mean, I was trying to look at different numbers in the reports. I didn't understand why. Maybe it could be that the small difference in revenue really was supposed to trickle down all the way to the bottom line, and it's in the percentage it's not big for the revenues, but in percentage it's big for the net income. But I don't think so. I mean, I don't think so. I don't think that's the case. There is something here affecting specifically the profit margins, or some elevated expenses, which I'm not aware of. I mean, they're lowering the expenses right now. They're like restructuring their costs because of the slowdown that is beginning. So I don't understand that. But it's again. What's scary here is that it's something that could affect us in 5 years, in 7 years from now. So yeah, and I feel like I'm mentioning most of the bad things, and this is like, I'm sure that if anyone is watching it, which they don't, but if anyone is watching it, like, why would you invest in a company where there are so many red flags? First of all, I don't know if I would invest. I'll get to the conclusions in a second, but I don't know if I would invest in it right now. I probably wouldn't, but I don't think it's still sell for me. Also because I got to that in the conclusions, but it is still a good company. There are some good things. I mostly mentioned the bad things, but again, the high return on capital, and I think they have a moat, and they have those crazy expensive coats which people love, and they're growing. They're growing their products variety, their product offering. They're growing geographically. So again, of course, there would be a recession and there would be hard times, but long term, I think they should do. Would I want to invest my family to depend on it for 20 years? Yes. I mean, yes, it looks like good business. Just if it was just a business across the street from me, and they offered me to pitch in and to invest and to have some of my capital invested in it, I would. So I don't know. Maybe I'm making a mistake. I'm probably am, but never mind.
I'm jumping ahead. So valuation. So this is the pessimistic scenario. Let's see. I think we have 4 scenarios here. Yes. So this is the pessimistic, where the growth, if they have a recession, of course it could get a lot worse, but I'm trying just to like normalize stuff. If they have a recession and they have a decline in revenues, which they haven't had until now, and then they do manage they should grow because they're opening all those new stores. It's hard for me to believe it's for nothing and there won't come any sales from them. So so then they manage to grow, and they will have this 6.5%, 7%. Net income margin, like we said in the pessimistic scenario, and this will be the EPS, and the PE mostly derive it from the growth rate. So when the profits will decline, they'll probably have a PE of 6. The revenues will decline, like a PE of 6, but when they get back to growth, they grow 15% a year, their PE could get to 22. So this will be the price. So first of all, we'll see in all scenarios, there is still much room for a downside, and the stock could, even tomorrow when they announce their yearly results. No, it's not yearly for them because they have this different cycle, but it could get much lower, much lower. But then eventually, I do believe it will rebound, and in this scenario, in the pessimistic scenario, it could get to $20 in like 7 years, and from the current share price, it's gonna give another return of 11%, which of course is not enough. I wouldn't invest in it. If that was the plausible scenario, I would not invest in it. And again, I'm not sure if I would invest in it today anyway. So yeah, that's the pessimistic. So just to go over it a little bit quickly, the plausible scenario is that they will continue to. I mean, this year they're not growing, but if they manage to grow, 7% is low for them in the pace that they're opening new stores and introducing new products, and they should grow really more than 7%. So 7%, I think, is low. It means that there is a lot of headwinds. And then they managed to fuel growth, and things look a little bit better. So yeah, and a little bit better profit margins, still far from what they're aiming for. So this is the share price by a year in this scenario. It's a little bit better, still not crazy, but it could give you like a 20 return. Again, from current share price, which is around $12, I think. Maybe it was 10 when I did that. No, I think it was 12. So yeah. So this is the plan. So again, the same scenario, just with a little bit better margins. I mean, here it's 6, 7, 8%. If we check it with the 9, 10, 13%, which is already optimistic. Yeah, that's the optimistic margins. But the plausible growth rate, those will be the prices where the stock price could get. So this is a better return, of course. Yeah. And this is the really optimistic, which I don't even want to mention, and it's still not where the management thinks they will get. Again, okay, I have talked enough about it. So yeah, so you could expect, in this scenario, you could expect a 23-25% return a year from it. It could 3x. Yeah. Yeah, just to make a few conclusions, we'll be much smarter tomorrow. And I really wanted to do it before they have their report tomorrow and the conference call, because it would get me much more confused, and I will have this video to refer to when I try to make something out of it. But definitely something is fishy with the management. And again, I want to love them because it is the grandson of the founder, and he should love this company. I mean, I'm sure he does. And care about it, and he is invested. He and Bain Capital together are the biggest stakeholders, so they have a lot to lose and a lot to win with this company, and they should care. I mean, again, they're not there just to get their stock options and move on. But I don't know, the behavior is weird for me, together with all the share buybacks, which didn't make any sense for me. The expectations, of course, which we talked a lot about, the short interest, which again, what am I missing? I mean, this smart money is shorting Canada Goose, so I have a lot of thoughts on that, which I will not share because I don't know. So it's definitely not a screaming buy again. Like I said, I probably wouldn't buy it today because something seems off. But as I am in it, and I still kind of, maybe I am in love with the company. I don't know. I try to get emotions out of it, but I'm already on it. And for now, I'm really trying not to make a lot of moves in my portfolio until I get a little bit more clearance on my current holdings, like I'm doing right now. And I'm just to place my thoughts more in order after a while that I have been really off of analyzing stocks. So for me, I'm gonna wait a little more, and of course now it's their strongest quarter of the year, so we'll see. I mean, we'll be much smarter after tomorrow. So anyway, there will probably be a recession sometimes in the next years. I mean, it's very, very, very plausible, and Canada Goose is gonna suffer. But if you invest right now, you're trying to look past it. If one should look at it as a very cyclical stock, then I'm not even sure that this is the ultimate pessimism and the ultimate bad point where like Peter Lynch said, that you should wait for the blood on the streets and then for the little bit of improvement where things just begin to start to look a little bit better, then you should buy. We could be far from that point. I mean, it could be good lower and lower and lower, and it could stay there for a long time. And then only would begin the improvement, and the improvement I'm talking about like from $2 to $4 a share, and this is the improvement, I mean, which is 2x for people who did cut that bottom, which of course I'm not aiming to do. But yeah, I mean, in terms of cyclicality, I for sure haven't invested in the best of time, and I learned that lesson really well now with probably all my holdings, but even now, maybe it's not yet the time to invest in Goose. But it could give an okay return. Again, I'm kind of, I think I'm maybe double thinking with the recession. Will there be a recession? Will there not be a recession? If there will be a recession, it's gonna take longer. If there will not be a recession, which there probably would, it could get good returns. Like we said, like 24%, 25%. This is, but let's say 20%, 18%, which is great. It's great for a company, again, with a high return on invested capital and a strong brand recognition. And I think it does have a moat. So, yeah, I think I said it all. I think I said too much. So, yeah, this is it. We'll be much smarter tomorrow. Bye-bye.